This video is all about property, the taxation of property, and also in particular and in detail about how interest works through those calculations for tax. This is part of a series of videos about accountancy and tax issues. So if you'd like more content like this, then please subscribe to the channel, and it really helps me if you press the like button. Property. I think we all really like property and we like investing in property. And I think that's partly because in the UK we don't build enough houses, and that underpins the whole market and makes sure prices don't go down too much, we hope. And also because we don't really trust financial assets fully. I think in addition to that, a lot of people are just at the moment, we're looking to see if there are any bargains out there due to the current environment. And also, we've all got friends and family who've made a lot of money out of property, and naturally, we also want a bit of the action. So the taxation of property, there are 4 taxes that can be involved. So first of all, there's the rental income, which is subject to income taxes. And then there's the transactional taxes. So you might sell at a profit, which comes under capital gains tax. Then if you're buying a property, you pay stamp duty land tax. And then in the background, there might even be a bit of inheritance tax planning. Now, with the exception of stamp duty land tax, all of these taxes we're going to expect both now and in the future, because we're expecting to own the property for maybe 10, 20 years, who knows how long. And the tax system is likely to change over that period. So we have to sort of second guess not only what the tax system is now, but what it might be in the future. Now, with that in mind and future-proofing, a lot of people are moving to limited companies or buying their properties in limited companies. And the principal advantage of a limited company is that you don't have to pay high rate tax on the income. So the income goes into the limited company and not into you personally. And that means that you're not automatically subject to high rate tax. So for high rate taxpayers, it can make a big difference. But also, again, for high rate taxpayers, the interest on property is not fully tax allowable, which means that they're paying tax on a higher figure as well, and it can also knock them into a higher tax bracket. And for that reason, for one property, it's very often not worth putting in a limited company because there is extra admin. But for a number of properties, particularly for a higher rate taxpayer, a lot of people are choosing to go into limited companies and to buy their properties in the first instance through limited companies, because it's quite messy changing it, because you've got that land duty stamp duty to pay, and also you've got to organise the lenders to do the transfer, and it's got to be fully conveyanced. So looking at limited companies. So to look at that in a little bit more detail, what I want to do is look at how the interest is taxed, because what it does is it throws people into a higher tax bracket, and I want to show you how that works through. So in the example that I've got, I've assumed you've got 5 units, so a reasonable sized portfolio. They cost a sort of steady British price of £120,000 each. You've got mortgages of £100,000 to make the sums nice and simple. And you've got a rental coming in of £600 a month. I think that's a fairly reasonable assumptions. I've assumed an interest at 3%. So those are the core assumptions to start with. So if you have a salary of 45,000, so I've got you with a salary of 45,000, notice that you're a basic rate taxpayer on 45,000. You've got rental on the 5 properties of £36,000 a year. You've got an interest of £15,000. Now I've put that in brackets because that will eventually be disallowable. And then you've got other costs of £11,000. So your overall profit, your economic profit, is £10,000. However, taxable profit will be £25,000 because the interest is not tax allowable. So you add the £15,000 to the £10,000 to get £25,000. Now what that means is that your total income will be £70,000. So you become a higher rate taxpayer. It's also noticeable that at £70,000, you don't get any child benefit. So if you've got 3 children, then you're going to lose a lot of money by losing your child benefit, so it's really relevant to you. So on £70,000, your extra tax, you'll pay that, your £45,000 tax, you pay that through PAYE, but your extra tax on the property is £9,000. You then get a 20% reduction for the interest, so of £3,000, so you end up with £6,000 of tax. £6,000 of tax on an economic profit of £10,000, so you're effectively paying £10,000, 60% tax on your actual economic profit, which is very high, although, and 2,000, you know, it's very high tax, and it's, you know, something that most people would want to avoid. And by putting it through a limited company, you pay 19% of the 10,000 or 1,900. So you would pay a lot less tax. Now, what happens if interest rates go up? Because with all this money printing, I'm just thinking that inflation might increase. And when inflation increases, then interest rates will increase. So what most landlords, when I suggest that to most landlords, what they say is, yes, if interest rates increase, what I'll do is I'll increase my rent. So let's just assume those two net each other out. So my second example, I've got interest at 5.4%, and I've got rent at £800 a month. Those do actually cancel each other out. So you've got £45,000 of income, £48,000 of rent, because your rent's gone up because it's gone up to £800. You've got now £27,000 of interest, £11,000 of other costs, the same. So your economic profit remains the same at £10,000. But because you've got more interest, which is disallowable, your taxable profit is £37,000 now. You add that to your income, you've got £82,000 of total income. Your extra tax is £13,800, but got more allowance for interest. So that 5,400 is 20% of 27,000. So you've got that to come off to give you a tax bill on your property of £8,400, 84% tax. So what you can see from that is that if you've got, if interest rates do go up, even if you're allowed to put the rent up, and even assuming that, the tax is pretty much taking away almost all of the economic profit. And this is for somebody on 45,000. I can make worse sums than this, because if your income level is over 100,000, if the rental income takes you over 100,000, then you'll be paying just huge amounts of tax, just unimaginable amounts of tax, probably over 100%. So I don't even want to do those calculations because they're just too scary. But what it shows is that, and this can all this problem can be avoided by having a limited company. Now, I can't promise that by having a limited company, these benefits will go on forever. They could just disallow all interest for landlords, but if they do that, I think there'll be I don't know, it would cause a lot of problems within the market. So there we are. I've been through the taxation of property, in particular in relation to interest. I hope that's of interest to you. If you'd like to consider subscribing to the channel, you'll be very welcome. And please press that like button, because that really helps me. Thank you.